National Insurance Clearinghouse, the marketing arm of Brokers Alliance, presents a Bravo video event, the Business Insurance Zone, dedicated to financial professionals who use insurance in their practice.
And on today's show, Invisible Taxation with CPA Ken Davis.
And now the host of the Business Insurance Zone, the whiz of the biz, insurance columnist Steve Savant.
Well, hello everybody, my name is Eric Palmer, filling in today for Steve Savant, and we're broadcasting live to a nationwide audience of insurance from financial professionals here live from Fountain Hills, home of the largest fountain in America. With me today is Ken Davis. Ken, welcome to the show.
Good to see you, Eric.
Now today we're going to talk about some pretty interesting stuff, and all throughout the week we're going to build up the show here. We're going to address a couple of different issues. First and foremost, something that you're calling the invisible taxation, and we're going to address this invisible taxation with a way to build up a combination of annuity products to help minimize things like Social Security taxation and actually create what the buzzword we've been throwing around quite a bit, more net spendable dollars for our client at the end of the day. So as we go throughout this week, I would tune in. We're going to start talking today about some of the problems that you've identified, Ken, in the marketplace. And again, build up the rest of the week talking about the way that we can put some products together to address this issue, help out our clients. And later on in the week, we're also going to get into some things like compliance and suitability. So it's going to be a really powerful set of shows here. But what I'd like to do first is really talk about the main issue at hand, this invisible taxation. What exactly are you talking about there?
Well, it's interesting. I've known about this for a long time, or the basic concept for a long time, and so have CPAs, and it's essentially that we hear on television that we have a tax rate of X amount, that the maximum tax bracket is 35%.
Right.
We're going to start off with an example to set the stage, and then talk about how that happens, but it really has to do with computations that are based on adjusted gross income, and I know that's a technical term, but it's just simply the last number on the front of the page 1 of Form 1040. From AGI, the limitations on deductions, exemptions, credits are made. Social Security income taxation is a huge one, and that's what we're going to be focusing on mostly today. And amazingly enough, Medicare premiums are now based on adjusted gross income, even though Medicare premiums have nothing to do with the tax law other than they reference AGI. So let's start with the example, and then we'll kind of build on how this works and how we can use our own products to mitigate these
Now,
issues.
when we were talking about the show, there's something that blew my mind here because, as we all know, there's a variety of different tax brackets out there, the max being 35%. But with this example, you came up with a much higher number. How did this come to be?
Well, that's the fun part of it. It's an invisible taxation is what I call it, because what happens is our politicians have gotten used to the fact that they can't increase tax brackets. What they do is they come at it in an indirect manner and in a backdoor or invisible way of doing it. So they set the tax brackets, but then they include additional income, or they reduce deductions or exemptions, whatever. So they come at it from an indirect manner. So let's talk about this. A 65-year-old single woman, okay? A widow who's had a husband with a heart attack. She has retirement income of $10,000. Well, let's say no interest income for the first part of the example. $24,000 of Social Security.
Okay.
$30,000 of pension or other income. So really, in this example, $54,000 total, but only supposedly $30,000 of it's supposed to be taxed, right?
Right.
Because everybody believes.
So we thought.
So we thought. It's amazing. Some of us know that Social Security income is taxed. Maybe a lot of people in our industry, but there's a lot of our clients that don't know this. And so the fact is that the formula that brings Social Security income into taxation started in 1983. There was a court case back all the way to 1938, all the way through to 1983 when Congress put a new law in place that said 50% of Social Security can be taxed.
Right.
And then not too long after that, they increased it to 85% can be taxed.
Now that's a key point. I'm going to stop you there because we're always talking about these concepts, but really what they all boil down to is new ways to market and reach new clients out in the marketplace. And we were shocked. I was familiar with the fact that Social Security was taxed, but not to the extent of 85%. And then when we started talking to our agents and our advisors out there, we were shocked to find out consumers most often still aren't aware that their Social Security is being taxed.
Well, and the fact of the matter is we all know that clients make decisions emotionally. All of us do. We get angry or upset or really excited about something, and we tend to take action. We're human beings.
Right.
So from a marketing standpoint, if we can start to show clients first that their Social Security is being taxed, and then show them a solution using annuity products in a layering process like we're going to be talking about this week, we have a real winner. We can utilize our tax benefits on our annuities to a maximum advantage. So let's finish the example here. $54,000 of income, $30,000 of it you would think would be taxable, okay? So the bottom line is, when I ran it through the little H&R Block calculator online, and I'm giving them a free plug because they gave me a free product to work with, so it's really kind of cool. Anyway, if I do that, my taxation is $4,128.
Okay.
Okay? Now, I'm going to add to that example simply $10,000 of interest income. Let's say it's about $300,000 of investable
bonds, CDs,
CDs, money
funds.
markets, and maybe that's high, maybe that's low, but just say 3%, a little over 3%. So that's $10,000.
Okay.
So I add $10,000 to $24,000 Social Security, $30,000 of other income, and you'd think in a 25% bracket, which this woman is in,
Right.
that I'd have what, $2,500 or less, okay, in
Roughly.
taxation, roughly. But the fact is, we go from, this just blows me away, $4,128 to $8,338 in taxes.
So let me stop you there again. So we've got $10,000 of additional income being added in from the interest earned off of her investments. Again,
Right.
about $300,000 of investments or so. That $10,000 adds about $4,100 and change extra in taxation to the table. That's over 42%.
That's
41%.
$4,210 additional tax by adding $10,000 of income.
So she's in a 25% tax bracket, paying 42% on interest earned off of
Right,
these investments.
right.
That's unheard of.
It is, and it's so subtle, and that's why the politicians love this stuff, is because that's how they inch up things. And I love the fact that, gee, what have we heard over and over again? Rich people, rich people, rich people. Tax the rich, leave the poor alone. Well, I'm going to tell you, a woman who's worked all her life, has lost her husband, having $30,000 in pension income and $24,000, I don't consider her rich. I'm sorry, that doesn't work for me.
Very much in that more common middle America consumer that we're finding quite often. So,
And she's paying 42% in effective tax rate, not tax bracket, but effective tax rate.
and
See
that's
how
just,
they're coming at us in
and
an
that's just the
invisible way?
math. That's pure math. And if you want to get your hands on some of these calculations, we actually have copies of these reports. We have a taxation calculator, and as Ken mentioned, you can go to your H&R Block and get a free calculation to do this. But this is real stuff. And what blows me away is it's so easy to identify. If I'm an advisor, where do I find this information? How do I get at these numbers if I'm going to talk to a client?
Well, they're going to work with us is a good place to start, because we have the free report on taxes talks about the taxation of Social Security, which we're going to be going through. It'll have taxation of annuities, immediate and deferred. They can order those reports and get that information. And we're working on a program that we can actually do this service in-house for our brokers, that if they'll call us and give us some of this information, we can help develop strategies that'll reduce this type of thing. So this is a service and a situation that we want to help out.
So the main thing that we're addressing here today is the ability to put together a combo annuity strategy, but you use a specific term that I want to bring out: the modernization or the modernized version of a combo annuity. Why is it modernized?
Well, we're going to be talking in detail a little later on this whole thing. The reason it's modernized, it used to be that the main concept, and some of our more mature agents like myself know the old concept where you split it up into a deferred and an immediate. And the idea is that the deferred will grow back to the original total investment. So if I had $100,000 and I put $30,000 into an immediate and $70,000 into the deferred on a guaranteed basis will be back to 100 in 5 or 10 years or whatever it works. But that worked when we had much higher interest rates.
Right.
It doesn't work today.
Right. The idea of preservation of principal isn't necessarily what we should be driving our clients down the road for. It's more of an income strategy and a tax saving strategy, right?
That's right. So the point of today's show is to point out that adjusted gross income affects the taxation of Social Security income. We're not going to be talking about, but know that it affects the deductibility of certain deductions, exemptions, and credits. And amazingly enough, and a whole lot of people don't know this, Medicare premiums are based on adjusted gross income. For a number of years now, they actually increase if you have more AGI, and I think I calculated one time about $3,000 a year in additional premium because you're in a higher AGI level. And we're going to be talking about all this and how AGI is actually modified for this thing. It gets worse, not better.
Now we have a little bit more time here before we cut into the next segment, but let's start talking about that. Adjusted gross income. There's three different components in terms of how Social Security can be taxed. Let's talk about those briefly here.
All right, well, basically you start with adjusted gross income. They simply go to the front page of the return and they pull adjusted gross income from the bottom of the page. Then they add back to it half of the Social Security. So even though they're trying to figure out how do you tax Social Security, they actually include it in the formula at half the rate. So in a way, in my mind, they're taxing it just by doing that. So they add adjusted gross income, and then they add here's another one that gets people upset, is municipal bond interest. Municipal bond interest is sacrosanct. It's supposed to be tax-free.
I was just going to say, so we have clients and consumers out there that are buying these muni bonds, and in most cases they aren't tax-free?
Well, I wouldn't say most cases, but they're tax-free, but they get added to this formula to determine whether Social Security is taxed or not. So it's this indirect taxation. It's like it's this invisible hand of the government reaching in and saying, oh, you're not going to see this. I'm just going to slip this in like a magician. And what's interesting, it's called Modified Adjusted Gross Income, MAGI. I think they should put a C on the end to make it magic. It's the government's way.
Well, you heard it here. It's the invisible taxation, and I think that's a buzz phrase that we should be taking into the homes when we're talking to our clients. If you talk about invisible taxation, you're going to have their attention.
Well,
now,
and I understand as an agent who sells that we got to try to keep this stuff simple.
Right.
So what we want the agent to do and what they can do to help themselves and their client is simply ask this question. Do you have an amount on line 20B, as in boy, of the front page of your tax return? Either get them to show you page 1 or ask them to pull that number off. If it's 5 or 10 grand or more, that means they're being taxed on Social Security, because that's what 20B is. 20A is the total Social Security received. 20B is the portion of A that, based on the formula, is now includable in income.
So if I'm an agent in the house, I'm looking at some tax, or I should be asking to, I'm going to identify line 20B as in Bravo, and if I see something in there greater than $5,000, I've got something to talk about.
Well, I think so. I mean, even 1,000, you could have some help. But I'm figuring 5 or 10,000 or more, you've got a serious situation that you could have an impact on.
Well, this is pretty interesting stuff. We're going to continue to talk more about this here in the second half, and what I want to do is dig a little bit more into how Social Security can be taxed. We're going to talk about capital gains, how that can play into the mix, and then what we want to do is adjust or address how we can put together some annuities and how these annuities are also taxed. I think learning about the taxation of annuities are going to be really important here to understand the whole story. Now, you're listening to the Business Insurance Zone. It's a talk show that focuses on your insurance or insurance in your practice. And you can email us at thebiz@brokersalliance.com. You can also call us at 1-800-290-7226, extension 147. Now, coming up here, Ken and I are going to be back. We're going to be talking more about the combo annuities and how we can reduce taxation. That's all going to be right after a word from our sponsor, Brokers Alliance.
Whether you're a professional planner pursuing a strategic partner or an insurance distributor seeking a national alliance, your business just went into overdrive. Now enter the largest resource of insurance products and services with unparalleled access to a worldwide audience of consumers through the National Insurance Clearinghouse, the marketing arm of Brokers Alliance, who can take your company and launch it into the stratosphere of success. With countermeasures, the most comprehensive carrier intel in the industry, the MASH unit with field triage underwriting and the premium tolerance test, the life insurance financial evaluation, the most rigorous policy review, and Bravo high definition broadcasting with online social media. Your search just ended.
Well, welcome back to the Business Insurance Zone. I'm Eric Palmer, filling in today for Steve Savant. the insurance columnist and financial commentator and interviewer extraordinaire, and hopefully I can fill those big shoes. But remember, before moving forward with any of the planning strategies that we talk about on this show, please seek approval with your CPA, attorney, your broker-dealer, or broker-dealer compliance divisions. Now, you can also reach us toll-free at 800-290-7226, extension 147, for any of your quotes or questions about life insurance, annuities, DEI, long-term care, and of course what we're talking about here today. And make sure you can also send us an email at thebiz@brokersalliance.com. And it's not what I know, it's who I know. And today on the show, of course, Ken Davis. Ken, I couldn't even begin to talk about all the acronyms next to your name, but let's just put it this way. He knows his stuff, and what we're talking about today is pretty powerful stuff. We're addressing taxation. We're addressing the invisible taxation and how we can hit that with a combo annuity strategy. So let's get back into this here. Ken, on the first segment, we talked about something pretty interesting. We're saying that adjusted gross income is used, of course, to and half your Social Security to calculate these Social Security taxation. We also mentioned that municipal bonds can come into play there. Talk about capital gains. How can capital gains also affect the taxation of Social Security?
Okay, well, let's just go back and set the stage here a little bit to make sure our listeners are understanding what's happening here. There is a line on the front page of the tax return called 20B. 20B is the portion of Social Security that's being taxed. So 20A is the total Social Security received by the taxpayer, and B is the portion that's being taxed. Well, the government came in 1983 and said, gee, we no longer can afford to let our retirees receive Social Security tax-free. That was huge. That was a big deal, and that opened up the door. And initially it was only 50%. Well, now up to 85% of Social Security income can be taxed. And what's even a very subtle bit insidious is the fact that we're used to tax brackets that you get taxed so much at this amount and then the next amount, and it doesn't go back and affect the earlier ones. Well, what effectively happens here is you can get the entire Social Security being taxed at up to 85%. So you may start at 50, then phase into 85, and ultimately it's all 85. And how they get there is a formula where they start with adjusted gross income. It's the line on the bottom of the front page of the tax return. Okay. Then we add to it adjustments. That's why I love this, adjusted gross income, then it's modified adjusted gross income. Only the government can come up with these crazy terms.
Right.
And we're going to start adding C for magic because they magically tax more than they should. All right, so modified adjusted gross income. And the modification is we add back half of the Social Security income to adjusted gross income. So in this case that we used in the first part of the show, $24,000 is cut in half, $12,000 gets added to AGI. Then in addition to that is if this taxpayer, any taxpayer, has municipal bond interest, that gets added into adjusted gross. And I don't know how you justify that. It's supposed to be tax-free, and technically they're not taxing the municipal bond interest, but they're adding it into the formula to determine if Social Security is taxed.
Should be taxed, right?
So this is what I mean by invisible taxation. They're coming in through the back door, and they're hiding this. They're not calling it a tax bracket, but it becomes an effective tax bracket. And then this is kind of interesting. It's very subtle. The formula doesn't say add capital gains back because they don't have to. We think if I asked you or anybody on the street, most everybody would know that capital gains are taxed at 15%, right? Well, what happens is if I got $10,000 in capital gain, technically I pay $1,500 or 15% in taxes, but the entire $10,000 flows to the front page of the return and floats down to adjusted gross income and then gets included in modified adjusted gross income to determine the taxation of Social Security.
So is that a double dip? I mean, is that this seems strange to me. I'm thinking, well, I paid my capital gains, but the entire amount flows back down. It's added to the big pile of money again. That's determining whether or not I'm hitting that 85% mark for Social Security. So in a sense, it could be considered double taxation.
Yeah, in my mind it is. And effectively, we showed in the first example, an additional $10,000 of interest income, fully taxable income, actually increased taxes by $4,210. That's a 42% effective increase in taxes. So, this is what Social Security taxation is. It's a formula based on AGI, add municipal bond interest, add half of Social Security, and already included is the full capital gains that ultimately get taxed at a lower rate later on, but the full amount is actually included in this process.
Now, as we go through this thing, I really want to point out the fact that Ken is here with Brokers Alliance as a consultant for our advisors, and a lot of this stuff can be tricky. So what we encourage you to do is get a hold of our report. It's a 66-page report on everything taxable inside the world of insurance. But more importantly, we have some worksheets, we have some calculators, and of course Ken's expertise to help build that case for your clients. So bring us the numbers. If you can get your hands on the tax forms, bring those in, and we'll help you determine how much of this is actually applicable to your client and help you build the model. And I think that one of the most important things as an advisor out there is to be able to have someone that they can turn to for the advice or for a consultation on taxes, because that's the hot topic right now. When we're in a low interest rate environment, taxation is everything.
Well, we want to make sure our viewers remember our caveats that we are not offering tax, we're not consulting with you on taxes. We're helping you with tax concepts that'll help you identify what we can do as insurance agents to reduce taxation. Ultimately, the actual calculations need to be done either by a client who's very sophisticated or capable of dealing with this, or has a tax advisor and is taking that responsibility. But this is an interesting aside. Many of us are afraid to talk to or include the CPA in this process. Why?
Right.
Because CPAs generally don't like commission salespeople. That's just the reality of it. And frequently they say no to us. But I'm telling you something, that if you go to the client and say, we want to save you several $1,000s a year, and we want you to go back and utilize your CPA to do a tax projection, what do you think the CPA is going to think? They go, oh my gosh, an insurance guy who's including me in the team, he's not excluding me, and suddenly he sees that this concept actually is saving taxes, the light bulb may go on in their head. Now, you may get one of those intransigent CPAs that just don't get it, but I've presented to quite a number of CPAs over the years, and when you show them there's real value in that it works, and they're now included in the process as part of the team, you may create an ally, and guess what? Allies will refer additional business because they didn't know this was going on. They knew it was tax, they just didn't know how to solve it.
Well, we say it a lot in the industry. We always tell you to go find alliances with attorneys or CPAs. But quite often, our advisors come back and say, that sounds good in theory, but how do I break the ice? How do I get in there? I think the stuff that we're talking about today is a huge opportunity to go find a network of CPAs and talk to them, because at the end of the day, we're bringing them back in the fold and creating more opportunity for them and their clients. And at the end of the day, what better marriage could you have formed there in a professional sense?
Well, and the thing is, we expect CPAs to like us and then refer to us. They're very uncomfortable saying, gee, Eric Palmer's this great insurance guy. You really got to go see him just out of the blue. Well,
right.
That doesn't work. Clients go, huh? I thought you're here to protect me, not to send me down the street to an insurance guy, right?
Right.
So instead, now they can say, they can learn from the first one or two examples. They can actually sort through all their tax preparation documents and find all the clients that have a number on line 20B. And they can put minimum of 5,000 or 10,000. And they can actually identify clients that might benefit from this. Not everybody benefits, but some could. And now they're acting as what? A tax advisor. And now they're saying to the client, I was reviewing your tax return, and I think I might be able to save you thousands of dollars a year, and I want you to come in with myself and another expert that combined as a team, we can help you do this.
Right.
That will allow them to sell and not feel strange about it, because they're doing what? They're tax people helping their clients as tax advisors.
That's a great point. Now, we've addressed here some of the tax issues, or in terms of how Social Security tax can be calculated. And we've mentioned here on the beginning half of the show that combo annuities are kind of the solution that we're running with here to address this issue, address this problem. Let's before we get into the combination of the annuities and how we kind of put things together, let's first talk about how deferred annuities are taxed in the first place. Tax deferral on annuity, we all know that it exists, but let's address that a little bit more deeper. If I put my money, non-qualified or even qualified funds, into an annuity, it's tax deferred.
Yeah, we're going back over some basic stuff. Many of our agents will already know some of this, but what we're going to do is we're going to show some of the more traditional concepts of deferral, and then show how to put them back together again in a formula or a structure, as it were, that works for the situation. Well, the old the annuity is first deferred, so there's no Section 1090. There's no Form 1099
right
at the end of the year. So all of those earnings are deferred. Now, as time goes by, more and more of what's built up is taxable income and is deferred income. Then there's the immediate annuity. And, well, let's back up. If I've got that deferred annuity, I've got built up earnings, and I
Right.
take a distribution, a term that CPAs and accountants and financial planners know is LIFO and FIFO. Last in, first out is LIFO, and first in, first out is FIFO. Gosh, boy, I remember this back in my first accounting classes
Right.
many years ago.
Right.
It kind of spun my head. But when you take money as a withdrawal, not an annuitization, as a withdrawal, there's two separate tax laws for annuities. One is withdrawals and one is annuitization. Withdrawals are last in, first out. So that means that if I've got a layer of income in there, the income comes out before my contributions. And why that's important is the income's taxable, the contributions aren't.
Right, and that's also applicable to the income riders that are out there today. There's a lot of questions that we get often. Are the income riders treated any different? They're not. They follow the LIFO method.
That's
so
right.
the phantom interest or the accumulation that we're seeing is still combined on top of basis, right? Our original principal inside this annuity, if we're talking
Right.
about non-qualified funds. And that too is taxed up front as it first comes out. So there's a lot more that we want to dig into here as far as annuity taxation goes. I know that we're running out of time here on this show, but that first core principle is really what we're going to lead on in the rest of the shows coming out throughout this week, is the ability to defer these taxes inside these combination annuities. That's the step one in addressing the issue of invisible taxation. Now remember, you can view and download this show and all of our shows in HD 1080p on our on-demand video section. Just click on the red button right below the video you see on our homepage at www.brokersalliance.com, and our social networks include YouTube, Vimeo, Facebook, LinkedIn, and Twitter. Now, this is Eric Palmer. I'm filling in again for Steve Savant. You've been listening to the Business Insurance Zone. That's the buzz on the biz for today. Get into the zone, the Business Insurance Zone.
This has been a Bravo video event of the National Insurance Clearinghouse, the marketing arm of Brokers Alliance, one of the largest distributors of insurance products and services to a nationwide network of insurance professionals. Need insurance guidance? Call Brokers Alliance. Business Insurance Zone, dedicated to financial professionals who use insurance in their practice.